Good morning. It's Wednesday, the 9th of October, and this is Govindraj Ethiraj, headquartered and broadcasting as well as streaming from Mumbai, India's financial capital, distinctly warmer and smoggy now. The take. Last week, Mahindra Mahindra announced that it's just launched Thar ROXX, clocked 176,000 bookings within the first 60 minutes of the window opening. The ROXX, an SUV, starts around 12 lakh rupees and goes to about 22 lakh rupees. Mahindra had a similar run with its XUV 700 model, which had a peak waiting period running into 18 months post-COVID, helped also by the fact that there was a slowdown in production amongst most automakers at that time. Right now, many hybrid car models like Toyota's Hycross hybrid have waiting periods running on to a year. On the other hand, India's car dealerships are overflowing with unsold cars. Latest figures from the Federation of Automotive Dealerships says that there are close to 800,000 unsold cars worth about 80,000 crore rupees lying with them. Inventory levels are now at a record 80-85 days. So as much as Mahindra's new Thar version is being sought after, other cars, including entry-level ones, are not doing so well. In October 2023, India's largest car maker, Maruti Suzuki's chairman R C Bhargava, said he hoped that demand for smaller cars would make a comeback in the next 2 to 3 years, stressing that this was important for the growth of India's overall passenger vehicle industry. And that made sense. Except that Mr. Bhargava said roughly the same thing again a month ago or a whole year later at the company's 43rd annual general meeting. He reiterated that Maruti remained committed to its small car lineup, projecting a revival in the segment by 25-26 or next financial year. He also said he firmly believed that low-cost and small cars were necessary for India's economic and social conditions and that a temporary setback in demand would not change Maruti's strategy. And to put the numbers in context, Maruti's small car sales have been falling by more than 12% in the April to July 24 period, and its utility vehicle segment, however, grew about 16% in the same period. But then overall vehicle sales, that's car sales, have been falling, and particularly for September, there could be other reasons for that. Now, you can't fault Mr. Bhargava's logic, which is that upwardly mobile consumers aspire for cars, and as they do, often graduating from two-wheelers, entry-level cars make the most sense. Now, that is the theory, but it's not quite working out in practice right now. Car dealers have told me in recent months that potential buyers for entry-level cars are not able to put together the loans to do so because they could not bring in the minimum amount of down payment. On the other hand, car prices have jumped up in recent years. Former Federation of Automobile Dealerships Association President Manish Raj Singhania told me just last month that salaries and incomes have not risen by the 70% or so that car prices have. Average prices for passenger vehicles, which were around 6.5 lakh rupees 4 or 5 years ago, are around 11 lakh rupees, he told me. The more premium cars, including SUVs, have of course done well or better in a phenomenon that is now well documented as the premiumization of India's consumer economy. There are evidently 2 or 3 factors intersecting with each other. First, consumers will always stretch themselves if they see something new they like. And second, of course, if they see good value. Mahindra's Thar is clearly a model consumers like, though I personally found its Jeep-like ride challenging for longer drives. And then there is the classic value proposition, like in hybrid cars, or for that matter, even electric, though now hybrids have overtaken electrics in sales. So the question that follows is, are consumers not finding the current crop of car models interesting or exciting enough? Nilesh Gupta, director at Vijay Sales, which runs about 143 consumer durable and electronic showrooms across India, once told me in the context of a question on slowing sales that nothing turned around sales better than a new model. He was referring to color televisions, but the same obviously applies to cars, at least to some extent as well. The other more dreaded question, of course, is there a fundamental slowdown that's kicking in? It's possible, of course, but we'll have to still wait for a month or two and pass the festive season before we attempt an answer. Till that point, India's auto industry will depend on hope and, of course, car dealerships to park their unsold cars. And that brings us to the top stories and themes for the day. The stock markets recover on political, domestic and China international cues, could stabilize now. Oil slips once again after demand woes weigh. Decoding the Nifty50 as an investment strategy for the medium to long term. India could see a new direct tax code coming. What should it not contain? And finally, the touchscreen era may be ending.
This is the Core Report with Govindraj Ethiraj.
Markets stage a recovery. The stock markets recovered after the BJP's win in local state elections in Haryana was received positively as a larger mandate for continuity of public investment-led policies, as was the fact that the China pull may be moderating for now as investors there held out for more stimulus packages. Snapping a 5-day run, the Sensex gained about 584 points to end at 81,634, and the Nifty 50 closed at about 25,013, up 217 points. The next thing to watch out for is the Reserve Bank's monetary policy today, and if there could be any interest rate cuts, though it seems unlikely for now. FIIs are selling. The value of foreign institutional investor holding in Indian markets has crossed $1 trillion. That's the cumulative assets, including debt, equity held via different instruments. And that figure is up around 27% since the beginning of 2024. Most of this was equity, about $930 million. On the other hand, FIIs are pulling back right now, and they pulled out close to 40,000 crore rupees from Indian equity markets in just the last 4 sessions of this month. The BSE Sensex and NSE Nifty fell about 5% from their record highs before, of course, recovering somewhat on Tuesday. According to a report in Business Standard, foreign investors invested about 150,000 crores so far in 2024 and pulled out about 93,000 crores, which makes them net buyers of about 56,000 crores. So they are net buyers and fairly substantially too. Foreign investors are actually weighing several factors at the same time, from the recent exuberance in and for Chinese stocks to the tensions in the Middle East, and of course, the lingering uncertainty of who will become the next president of the United States. The larger challenge is, of course, in India, that is, present valuations, though all foreign brokerages swear by the longer-term structural story of India. Nomura Securities said in its report that MSCI India currently trades at a forward PE of 24 versus the post-2015 average of 19.5. And after last week's pullback, should some of these concerns materialize, they think valuation levels going back to 21x should become an attractive point for investors to start rebuilding positions in the market, according to a report in the Business Standard. Oil prices fall back. Demand indicators for oil continue to be weak and are offsetting the risks flowing from tensions in the Middle East, at least to some extent. Brent crude dropped below $80 a barrel after China's top economic planning body did not offer any new stimulus measures on Tuesday, as was widely expected. Oil lost as much as 2.2%, again snapping a 5-day rally. The National Development and Reform Commission of China said it's confident of reaching economic targets this year, but the lack of new spending disappointed investors, Bloomberg reported. Traders also continue to watch closely for Israel's retaliation against Iran following a missile attack last week, which raised concerns over an all-out war. Meanwhile, the global economy is entering a dangerous time like never before as Middle East tensions remain elevated, S&P Global's Vice Chairman Daniel Yergin said to CNBC. Yergin is a big voice in oil markets, and he told CNBC's Squawk Box Asia that he expects Israeli retaliation will not just be a replay of last April, but something much stronger. When asked if the global economy is on the precipice of another supply shock resulting from these Middle East tensions, Yergin said it's a precarious time for markets. He said that the betting is that the Israelis would not attack or try to attack the nuclear facilities at this time, but a few months from now, a few weeks from now, whenever that is, or whatever that is, Iran would have the capacity, it's thought, to deliver a nuclear weapon, and that raises the stakes, he said, likening the moment to the 1962 Cuban Missile Crisis. Bottom line, there's a lot of uncertainty ahead for the oil markets, or for that matter, all markets. Why the Hyundai IPO is giving me jitters? It's the largest IPO or initial public offer at about $3 billion or close to 25,000 crore rupees and is a cause of worry, at least to me. This is as much for the time at which it comes, which is the somewhat middle of a current bull run, as of course its size. Actually, I don't know whether this is the middle of the bull run or not, though it does feel like the moment of time when a few corrections can and perhaps should set in, as they already have to some extent. Reuters is reporting that Hyundai Motors IPO will open next week for subscriptions, will likely priced in the range of 1,865 to 1,960 rupees per share. So that's close to 2,000 rupees per share, according to sources. And this would value Hyundai close to about $19 billion. And this, like we've said before, is the country's biggest stock offering this year, or ever for that matter. The India IPO will be Hyundai's first stock market listing outside South Korea, and it will also be the first car maker to go public in 2 decades since Maruti Suzuki in 2003. The IPO should open for subscriptions for big institutional investors on October 14th. That's literally a week's time from now, and retail and other categories a day or two later. A strategic look at investing. The The markets have recovered yesterday somewhat from a 5% fall in the previous week, but going ahead, how could things pan out? In the context of two factors, the external, which is still unpredictable, versus the internal, including the politics, which is somewhat predictable, at least for now. The core report had earlier pointed out that the present market corrections have largely been driven by external factors so far. So how should one look strategically at the stock markets in the medium to long term? Second, the Nifty 50 basket is an interesting study and illustration of how stock picking can be more scientific and organized than you might think. For more insights on that, I'm now joined by Siddhartha Rastogi, Chief Operating Officer of Ambit Asset Management based in Mumbai, which manages close to $500 million of funds right now. And I began by asking Siddhartha how he was viewing the medium term and then on to the Nifty 50 basket.
Govind, it's a very interesting question. And as you rightly said, that there are contradictory domestic and global geopolitical situations which are building up. On one side, we saw that India is strengthening from the political perspective, and on the global macro side, we are seeing that the Iran-Israel conflict is escalating. And what we saw in last couple of days, the meltdown or the selling, that was predominantly the result of that global hiccup or the global challenge. Now, I would break the investment in Nifty into three parts. One is immediate term or the short term. One is the medium term, which pans out for next 6 to 7, 8, 10 months. And then is a longer term when I talk about for next 18 months to 24 months. Now, interestingly, what is going to happen is for understanding the future, you have to look at the past. If I look at the Nifty returns for last 1 year, it has been closer to 26 odd percent absolute number. This I'm talking about as of yesterday, or if I include that, it will be closer to 27.5 odd percent in a 1 year return basis. Now, if at the same time, if I look at the earnings, Nifty earnings for last 1 year, it has been in the range of 14-15%. If I look at the trailing P multiple of Nifty, it has been in the range of 23 half, which essentially means from a trailing perspective, little bit Nifty is expensive. But then you have to compare the market. If I look at the same thing from the broader markets, which is mid cap and small cap, I include the entire factor. Last 1 year returns for the mid cap has been closer to 42.5%, and a similar number is there for the small cap for last 1 year. Whilst if I look at the earnings side, the earnings have been half of the number which has been delivered by both mid cap and the small cap. So what are we implying here? We are saying that 50% of the growth in last 1 year has come in from the EPS growth, but balance has actually come in from the earnings expectation expansion. Understand this, earnings expectation expansion, which means P expansion. Is it sustainable? May or may not be from here. If I look at the trailing mid-cap multiple, it is relatively on an expensive side, which is closer to 46, 47 times. If I look at the small cap, the number is quite similar, 48, 49 times the trailing small cap index. So Nifty from an immediate term, keeping in mind where we are, can see little bit of downside. How much downside? Maybe we are at 25,000 after today's move. We can slip down by 1,500 to at best 2,000 points. So what are we talking about? We are talking about closer to 8-9% of maximum Nifty correction, and that's not a real correction. That's a great buying opportunity, keeping in mind that the earnings of Nifty in next 2 years are going to compound at 14.5%. And if earnings only replicate without P multiple expansion, that's a great number to achieve. Imagine with the earnings little bit on the dividend side, if you are able to catch up, then Nifty TRI can comfortably give you a number which is closer to a 15% odd returns. So from a short-term perspective, my suggestion would be, if you have money, do not buy tomorrow. Maybe what you should do is look for the global macros. Haryana news has already been factored in. J&K is out. Maharashtra and Jharkhand, the elections are yet to happen. Things may turn either ways. Hence, at this juncture, be a little cautiously positive, but I would still wait for a little bit of correction in the Nifty before I put in the entire money. So that's From a medium term, 6 or 7 months perspective, very, very distinctly, it's a buy call. Earnings season is going to start, and my expectation is that the earnings season is going to be quite robust. Festive season, what is the indication we are seeing from the billion day sales, which has come in from the Flipkart and Amazon, which is going to come through? Numbers seem to be quite stacked up. And it is also the impact of the wealth effect. You understand the concept of wealth effect, because last 16, 17 months, people have made tons of money into the equities, and they would have a tendency to spend some bit during the festive season. So on the medium term, I'm bullish. In the longer term, very, very categoric. Even broader markets make sense from a 2-year perspective. If I have to have a time horizon of 2.5 years, I'm a buyer in the broader markets. But if I have a shorter time horizon, which is 6, 7, 8, 9, 10 months, I would stick my neck out and only play with Nifty.
Got it. Can you now break up the Nifty for us and how you look at the constituent pieces of it, particularly, groups and sectors and so on?
Absolutely. So Nifty, interestingly, after a long time, has been bucketed into parts. So we see financial services, which is closer to 33, 1/3 of the total Nifty is there. You see oil and gas, which is closer to 12 odd percent. You see IT, which is 14 quarter. You see FMCG, which is 8.5%. You see metals, which is again 3.5%. You see power, which is again 3.5%. And you see auto components, which is 8.5%. Now, these are some of the heavy weights into the Nifty. And then you have got a little bit of swing, which can come in from the PSUs, which can come in from some of the industrial houses, which have multiple holdings into the Nifty. Now, interestingly, we saw Nifty correction after a long time because of the macro reason. Otherwise, for the Nifty to correct significantly, it's quite challenging, because most of the components are insulated from each other. They are uncorrelated. So imagine financial services has large part on the private sector banking. And we have seen that the private sector banking, despite of earnings being relatively robust and with the rate cut, which may not happen tomorrow in India, and which may not, and there will be status quo which may happen, and eventually RBI will budge, and RBI may take a rate cut, maybe in December, maybe in January meeting. If that happens, then you have a positive mark to market on the securities which are available for sale into the banking bucket. So you would see that the private sector banks' profitability is gonna jump quite robustly. And that's one piece which is still not moved when the Nifty has moved. So you have one positive effect there. Now imagine, so which component has done brilliantly well? Power, metals, these sectors have done, oil and gas, they have done significantly well in Nifty. Again, to counter this, you have a pack of IT and FMCG. Can IT and FMCG fall along with metals, mining, power? The answer is no. So they are uncorrelated. And hence it creates a great mechanism. If you just blindly invest in Nifty, the chances of you making most money is most high. Similarly, if I look at last 1 year, auto components which form closer to 8.5%, they have extraordinarily delivered closer to 60, 61, 62% returns. Now, this portion, with the interest rate going little slower, auto again is going to support. So imagine what are the triggers. If macro markets go bad, if the interest rate cycle goes positive, which means there is a cut, you will have auto positivity, you will have positivity in the financial services. Now imagine if for some reason there is some catastrophe in the financial world, you have a uncorrelated market in the form of IT, you have uncorrelated market in the form of FMCG. So these buckets make a classic case of what we call it diversification. And I think in this world where things are just falling apart by the day, Nifty makes a great case if you want to have sustainable, relatively risk-free kind of an investing, if you have a time horizon of 2 to 3 years time frame.
Right. Thank you so much for joining me.
Thank you.
India's new tax code and the core report weighs in. The government has invited suggestions of the Income Tax Act 1961 from the private sector and tax experts beginning October, that's now, as part of an exercise to simplify the direct tax law. And the Business Standard reported this last week. The objective is to simplify the language and reduce litigation. The finance minister in the budget presented in July had proposed that the IT law review would be completed in 6 months, which obviously ends in January. And it's widely expected that the amended IT Act would be brought into the budget session of Parliament next year. The core report is doing its bit to contribute to the discussion in India's direct tax code by asking tax experts across the country for the 3 things that they would like to see or not see in this new tax code. And I began by speaking to Ajay Rotti, founder of Bangalore-based tax advisory firm Tax Compaas, and I asked him for his 3-point take.
Yes, they are rewriting, making the code simpler, etc. I think the most popular common things that are being asked is more on, the main mechanisms or really the fundamental aspects of taxation on what is tax at what rate and how do you compute and things like that. But I think there are few other things that need to be addressed. And in my view, 2 very key aspects. One is our whole tax code today is actually built on a huge trust deficit, that the taxpayers are there to arrange their affairs in such a manner that they will pay least taxes and things like that. And there are a lot of provisions around that. And second is on, administration. How do officers deal with the tax payers and how do you litigate with the government and things like that. I think there's a good opportunity to clean up on these aspects, which is more on the administration of the tax statute rather than the main statute itself and the provisions relating to levy of taxes. And if I were to take, a few examples, I think one key one on trust deficit that I can talk of is there is a very peculiar provision in our statute which says that any income tax authority can give instructions to the authority junior. Therefore, technically, a CBDT can issue any kind of instructions to all officers who are performing below the CBDT, or a chief commissioner can do it to officers below the chief commissioner and so on. However, they are precluded from issuing any instructions on giving directions to conduct a particular tax assessment in a particular manner. Therefore, if there's a taxpayer's case, individual case, they are prohibited from issuing any instructions. Therefore, what that means is the officer sitting at the desk is supreme and he or she can take whatever decisions they want in that particular case. I think provisions like these, which are really in place because there was always a trust deficit, need to go in my view. Therefore, today, technically, if a large taxpayer is having a particular issue on one officer interpreting it in a particular manner, they should be able to reach out in the system to explain that this is what the officer is doing, and therefore collective wisdom comes in and a senior officer takes a more pragmatic view, takes a more holistic approach to say, yes, we cannot be doing this. But that's not possible today. So some bit of that, those kind of changes can definitely be done.
And the other point that I think you wanted to touch upon is litigation.
Yes. So on litigation, Govind, again, very peculiar to India. And as I deal with a lot of foreign investors, foreign companies which are operating in India, and it applies to Indian corporates, but it's more pronounced in a foreign corporate case because they are not used to this system of litigating. Is in India, you can't litigate on taxes without paying money against the disputed taxes. However, that's 20%, 50%, it depends, and it can be anything, but it has to be at least 20% under Income Tax Act. It's a little lower under indirect taxes. I think this again is an issue that definitely needs to be addressed. Because if you are litigating with the government and if you actually lose after a while, you have to pay it with interest and penalties. So the money doesn't come free just because you are litigating, and the government does get interest. If you litigate after paying, it becomes an expensive proposition. And also there's an incentive for the tax officer because then you can make wild claims with some bit at least being collected. And therefore you have collected some money and then the taxpayer litigates. And when a refund is issued, the government actually pays with interest. And, therefore, this again is a very complicated process. And anybody who's actually dealt with litigation in India, tax litigation in India, will tell you this is the biggest problem. You pay some money and then you litigate and you win after many years and you need to get a refund, and that refund takes its own process. I think this is another classic area where the government can clean up, be a lot more taxpayer friendly. Not that they're giving any largesse to them, they're not giving any benefit to them in terms of waiving away taxes or anything, but you actually litigate, and then if you do lose after a while, you pay it with interest and penalty, but don't ask every taxpayer to pay money upfront before litigating.
Right. And last point, Ajay, so you talked about definition of income. Could you illustrate that with an example of either an inclusion or an exclusion?
Yes. So, and here the issue again is I go back to the original point, which is the deficit or the trust deficit that's there between the taxpayers and the authorities. Over a period of time, what is income? Because you pay tax on income tax on whatever is your income. So the definition of income becomes critical. It had a few clauses, and every few years there's a sub clause that's added, and it's become a very lengthy definitions. Too many things that are coming. Share premium, the famous angel tax, was added to definition of income to say if you issue shares at a higher than fair market value, that becomes an income for the company. If I transfer shares, Govind, and you'll be surprised, I transfer shares at a lower than fair market value to you, and you buy it. So a share which is worth 100, you buy it at 60, actually 40 is taxable in your hands because you got an asset which is worth 100 at lesser than, and there's a complex mechanism as to what that valuation has to be, etc. This statute is again in place because the government believes that people are arranging their affairs and moving assets and transferring at lower than fair market value. So you make life difficult for every transaction rather than go after those transactions where there is a possible issue. So the definition of income itself, there's a lot of possibility and avenues to clean it up. To make it quite simple, take out some of these artificial extensions that are there. You always have, anti-abuse provisions which you have, which can be invoked. And today, with the amount of data they are collecting, it's easier to catch. Some of these provisions made sense 15 years back when the government was not collecting as much information as they are collecting today. So that's another area where they can really clean up. And some of these cleanups will actually show results on the taxpayer rather than it just being a lip service of, a 300-page code has got reduced to 200 and so on.
Ajay, thank you so much for joining me.
Thank you, Govind. Pleasure always.
The touchscreen era may be ending. The tyranny of touchscreens may be coming to an end, the Wall Street Journal says. Companies that have spent nearly 2 decades cramming ever more functions onto tappable, swipeable displays are now shifting gear. Now, buttons, knobs, sliders, and other physical controls are making a comeback in vehicles, appliances, and personal electronics. In cars, the widely emulated ultra-minimalism of Tesla's touchscreen-centric control panels is giving way to actual buttons, knobs, and toggles in new models from Kia, BMW's Mini, and Volkswagen, among others, says the Wall Street Journal. Similar rebuttonization, as this new phenomenon is called, is occurring in everything from e-readers to induction stoves. Perhaps the most prominent exponent of this button boom is the company that sent us towards touchscreens in the first place, says Wall Street Journal, pointing to Apple, which added a third button it calls the Action button to its full slate of new iPhone 16s unveiled last month, after introducing the feature on its upscale Apple Watch Ultra and Pro model phones in recent years. It also added a button-like camera control input on the iPhone side. And as Apple's experiments or actions show, companies are not just rediscovering buttons, they're reconceiving them. Wall Street Journal says the switch back to physical interfaces is also in some ways a vibe shift. With touchscreens ubiquitous, what was once being viewed as a luxurious aspect is now becoming tacky, whereas physical controls done well now signal the kind of thoughtfulness and exclusivity once attached to the original iPhone. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.